All right, welcome to my Q4 2025 multifamily outlook, Q4 and beyond. If we haven't met before, my name is Michael Blank. I'm the host of the Financial Freedom with Real Estate Investing podcast, also the author by the same name, same cover. Look at that, easy to remember. About 1,600 reviews on Amazon. Check that out if you want. Also, our investing company is NighthawkEquity.com. We have about $300 million in real estate, so we invest in apartments, and we also teach people how to do the same thing. So we have a path of financial freedom for both passive investors and also for active investors as well. So right now, and previously, I'd say probably for the last 12 months, there's a lot of fear and uncertainty in the market. And so even with, strong inflation and unemployment data, the Federal Reserve has still hesitated to lower interest rates. Now, if Trump has his way, that will change here materially in 2026, but so far very hesitant, very slow to react. And real estate has been in the news, and not in a good way, right? Rising home prices, bad. Housing is less affordable than ever, bad. Most office buildings in foreclosure, even some apartment buildings, also bad. But is it possible that fear and uncertainty mean that there's opportunity somewhere? Does that mean opportunity? And Warren Buffett has said, be fearful when others are greedy, and greedy only when others are fearful. And it seems like we're kind of in a fearful market. So by that logic, we should be greedy. But it's really, really hard to do that, because really what happens is investors invest emotionally, don't we? Right? We don't really invest with our mind. We think we're smart and sophisticated, but at the end of the day, we look at our emotions. How do we feel? Do we feel ecstatic? Or do we feel kind of afraid and cautious? And it's always this dichotomy of, March in 2022, the height of the commercial real estate bubble. People are just diving in, greedy, right? Ecstatic. But honestly, looking back on it, even while we're in it, we're kind of scratching our head a little bit, going, my gosh, the numbers really aren't that great. Like, the outlook isn't really that great. And so everybody piled in, and then the pendulum swung to the other extreme. So how should we really invest? Should we listen to our feelings? Should we listen to our gut? Should we look at the numbers? I want to talk about that today here, because it's one of those times where the two are a bit in conflict. So there's a lot of fear and uncertainty in the market, and private equity funds are quietly investing billions in real estate while we have a very fearful attitude about it. Here's a recent article in the Wall Street Journal. It doesn't really write a lot about commercial real estate, but this particular private equity company, Brookfield, has raised $14 billion. Okay, that's billion with a B, to buy distressed real estate. And they're already invested a quarter of that, $4 billion, in mostly apartment buildings. Now, why would they do that? What do they know that the market at large doesn't? Now, one clue is in the article itself. This guy, Barron, said prices are well beyond what it would cost to replace the assets. And, this is important, they're 20 to 40% below what the properties traded for at their peak in 2022. So what's really going on? And might this be a buying opportunity, not just for billion-dollar hedge funds, but also for us? Now, in order to understand why prices are down 20 to 40% from their peak in 22, we first have to understand why they were so much higher in 22. So let's rewind the clock a little bit here and look at 2022. Three main reasons that prices were at their peak in March of 22. The first reason is that we had historically low interest rates. Now, as you probably know, the lower the cost of capital, the more you can pay for a piece of commercial real estate in order to get the same rate of return. Therefore, with interest rates at near 0%, you could pay more for real estate and still get a 15% IRR, or annual return, for your investors. Now, number two, the lenders were giving us an extraordinarily high level of leverage, typically 80% loan to cost. Not loan to value, but loan to cost, meaning that you get 80% of the purchase price, that's loan to value, but you also got 8% of the closing costs, and for good measure, 8% of the construction costs. It's a lot of leverage, historically at the historic high. Now, typically, the more you borrow, the less equity you have to put into the deal, and the less equity you need to put in, therefore the high return on that equity, right? So, therefore, the higher the I can borrow, the more I can pay to get more return on that equity. And the third factor, what was going on, was that prices were so high, is that the market essentially was frothy. It was this sentiment that I mentioned earlier, this greed that was going on. So you had low interest rate, high leverage, prices are going up, and everybody wants them. And you put all this together, and you can see that the risk of getting into the market at the time was actually on the higher end of the risk spectrum. Now, when I say on the higher end of the risk spectrum, you got this entire risk spectrum, general real estate in general, right? And you have some, you have on the higher end is, for example, turnkey real estate, something like that, buying a rental, doing stuff like that. And on the lower end is always multifamily. Now, I know that's the case because of the kind of loans we've always gotten in multifamily, right? They're always lower than any other asset class. They're almost always non-recourse, and then you get 2 to 3 plus years of interest only. You don't get that in any other asset class. And so therefore, lenders obviously have concluded that multifamily is the lowest of all the real estate assets, which is cool. Now, within that low spectrum, there's still a spectrum. And what I'm saying is 3 years ago, we were on the higher end of that risk spectrum. Does that make sense? And that is because the outlook for interest rates was up, right? We had historically high leverage, so we had more leverage than we normally historically do. So the risk-adjusted return was not that great. Now, why are prices lower? What happened? What happened since then? Why are they lower now? In a normal market, had interest rates increased normally, as in slowly, as predicted, we all predicted higher interest rates, but what happened is the speed with which it happened. And prices would have slowly gone down, and the market would have adjusted slowly as the market slowly adjusted. But what happened instead was the interest rates went up very, very rapidly, higher than ever before. And then also, with it, inflation happened. Lots of inflation, as you know. It was really all the inflation response with interest rates went up as well. And that really is something that no one could foretell or predict or really handle in a good way. So not only did the cost of capital increase a lot, which decreases prices, but also what happens is that the market kind of panicked. So that lenders specifically stopped lending. And they very radically decreased the loan proceeds. So we got much, much lower leverage. In fact, right after this happened, the most we could get was 65% loan to value. 65% of just the purchase price, not the construction costs and closing costs. And that was a huge drop in loan proceeds, right? Which means that if you wanted to buy anything, including multifamily property, you know how to raise a lot more capital to do so. And remember, the more equity you need, the lower the returns on equity. The only lever you have to pull is price. So prices go down because investors are always looking for the same kind of return. So that's what happened. And all of this fear and uncertainty in the market really created a lot of people that stopped investing. And there was blood in the streets, and no one knew what it would end. And sales of multifamily on the volume of that trade went down by like 81% over a 6-month period. And all of this contributed to what we're seeing now, 40% decline in prices over the past 24 months. Huge. Now, what is now the outlook for multifamily, right? So the consensus is that interest rates are going to remain flat or go down slightly. Now, of course, if Trump gets its way, he'd make the Fed reverse all the interest rates overnight, but who knows what that's going to happen. But the point is, the general consensus is they're going to stay at least flat, and they're most likely going to go down. But that's vastly different than it was 3 years ago. Now, let me just say this about high interest rates. In general, okay, like if we were buying new stuff right now, high interest rates aren't the problem because you just incorporate it into your analysis, which means that if your high interest rates are higher, you can obviously pay less for the property, okay? But the interest rates by themselves are not the problem. The problem was the rapid increase in interest rates. And that was a one-time thing in history that's never happened before. It really doesn't happen like that as fast as well. So the point is this. Interest rates are likely to remain stable and may go down somewhat. And if interest rates stabilize, which they have, it decreases the risk for lenders who are likely to start lending more. So the leverage is going to go up. In fact, we've already started seeing that. Loan proceeds have slowly increased from 65% LTV to about 75%. And the more you can borrow again, the more you can pay. So an increase in loan proceeds is going to slowly increase prices as well. Even if interest rates stay exactly where they are and loan proceeds continue going up as they, I'm sure, will, as the markets continue to stabilize, lenders are going to get more and more aggressive. That increase in loan proceeds alone is going to increase prices. I don't need the interest rates to go down at all. And so the other thing I'm seeing is a much more balanced market, and which means that it's neither sellers or buyers have an advantage. It's more of a balanced market. Now, at the height of the market, it was definitely a seller's market. Sellers got more than asking price. They got non-refundable deposits. It was nice to be a seller in 22. And then that pendulum swung to the complete opposite once interest rates started and no one was buying multifamily, even though sellers wanted the price from 22. And as a result, like I said, sales volume dropped considerably. And now what's happening is that the sellers who want to sell have started to drop their asking prices. That gap, that bid-buy gap is starting to close slowly, and the volume is slowly starting to increase as well. So we have a much more balanced market. And the other thing, and this has never changed, is that in addition to stable interest rates, rising leverage in a more balanced market, there's also very strong ongoing demand for rental property moving forward. Now, what I'm saying is that, why am I saying is the first reason for many is that we've had a huge housing shortage. You can just, search housing shortage anywhere and you get all this data. Here's one from Freddie Mac. It's the latest data that they had, and they're basically saying despite 5.8 million housing units that were built over 4 years since our previous estimate, housing demand has increased by almost the same amount, resulting in essentially very little progress in reducing housing shortage. So depending on which report you read, we're short between 3 and 5 million housing shortage based on the population. That's wild. But we have another problem, housing affordability. The high interest rates have dramatically increased the cost to own a house. So it costs now nearly $1,100 more per month to own the same house as it does to rent it. Now, historically, that black line there, historically, where you see the black line, it's been 14% more to own a home versus renting it, which is not bad. I want to own a home. I can do whatever I want. Cool. I'll pay a little premium. But right now, it's 44% more to own that same house than to buy it. And this is a historic high. It's never been like that. So this is really bad for Americans in general, but of course it drives a lot of demand for rental housing. So what's the solution? Well, one would be for interest rates to go down. That would certainly happen, but this may not happen. It's not likely to go back to where it was that quickly. And so the other one is to build more affordable housing, but that's not likely to happen anytime soon either. I have a graph here that shows the number of permits that have been pulled for new apartment buildings, and noticed a huge decline over the past 18 months. This is multifamily permits that were pulled. There's also a huge spike right after 2020, after COVID, because there were all this free COVID money that came out, and it got 0% interest, and we got free COVID money, so everybody pulling permits and building like crazy. All those apartments came out starting about 12 months ago, and they'll be most likely absorbed completely by the end of this year. But look at the decline in permits. Nothing. No one's building new apartments because it's too expensive to buy. And so in summary, we have a significant housing shortage. It's much more expensive to own versus rent, and it's too expensive to build new apartment buildings, which means that there should be strong demand for affordable rental units, and with that, rents and prices should go up. Now, is that actually happening? Are prices actually going up? Is there any indication that that's the case? And the answer is yes. This is another chart here. It's from Yield Pro magazine, if you can see it. Provides up-to-date news and information for multifamily industry. In the graph, you can see that there's the huge spike in prices. Obviously, in March of 2022 was the height of that. And then you can see how prices have sharply declined since then. But then at the very end of the chart, which is right around now, there's an uptick in prices. And so while prices have indeed been slowly going up, they're still down 18%. There's still a gap from the peak. But you can already see the prices ticking up in this chart, and we're already seeing in some markets like Dallas that there was a huge explosion of apartment buildings, and most of that got absorbed about 2-3 months ago. And you can already see the prices of those Class A apartment buildings starting to go up. And right now, in a lot of these metros, because there was so much supply in the market, Class A rental per month is about the same as a Class B or even a B minus, right? So if I'm a Class B tenant, I'm like, well, shoot, I'm going to sign myself a year-long lease in a Class A building. I might as well. And so as these new units are being absorbed, that's going to naturally start increasing again, and it's going to create that natural Class A, Class B, Class C gap, which has been very, very compressed. And we're already starting to see that in some of those markets. Now, for example, in Atlanta, where we have not seen that yet. The absorption is projected to be complete in the beginning of Q4. So we should start seeing an effect in that some weeks later in our rents. So we'll see how that goes, but that has been the general trend. So let's talk about the risk-adjusted return. Let's talk about, this is very important that as an investor, also if you're an active investor and you're dealing with investors, that you understand what risk-adjusted return, you can explain it, right? Because it's really important to understand. So what is this risk-adjusted return? It measures the amount of risk that you're willing to take to get a certain return. And the risk is totally different now than it was 3 years ago, as I already alluded to. Now, let me just spell that out here right now. So in 2022, the risk was higher because interest rates were projected to go up. The leverage was historically high, and there was pervasive use of floating rate debt. And so that was in 2022. Now, the risk in 2024 and 25, the risk in 2025 is lower because interest rates are projected to decrease. There's very low leverage compared to 3 years ago, and everyone's using fixed rate debt. So right there already is already much less riskier. Therefore, this combination has a much better risk-adjusted return. So for the same return, the amount of risk there is in the market is much, much lower than it was 3 years ago with the same return. Does that make sense? So here's putting it all together. Here's what I'm seeing right now. Right, I'm seeing a significant housing shortage, which means that it's going to, and you're going to, so housing shortage plus more expensive to own versus rent, which drives, again, the demand for rental property. And it's also too expensive to build new apartment buildings, so no new supply is coming on the market, and that is going to result in strong demand for affordable rental units. Now you add to that a little bit of fuel on the fire, which is stable to lower interest rates, and now you're getting higher rents and prices. You're getting higher rents from the demand, and coupled with the higher rents and the stabilization of the interest rates, which also will drive higher loan leverage, will now drive up prices. But again, right now, prices are still 20% plus below their peak. Okay, and so really what's happening is we're getting a much better risk-adjusted return than we did 3 years ago. Now, what this means though is that we have low prices, we have fear, high demand and projections for higher prices, but lower risk. And this is why I believe that we are in a unique window for an investment opportunity. It reminds me a little of 2008. The problem is how do we overcome this fear factor, right? How are we looking at these numbers going, yes, but here's what I read in the news. Or maybe you actually even invested as an LP in a multifamily like that. I'm not doing that again. And it's very important as sophisticated investors to try to become as objective about your investments as possible, to detach yourself as human possible from your investments and realize and look at the numbers, but also be willing to understand when you make a loss on something, why does that loss happen? Can you explain and understand the loss? And how likely is that loss going to happen again, knowing what you know now, right? So it's this thing is like, okay, you can't change the past, but what do I do moving forward? And this is a difficult thing to do. This is why I do continue to say, especially now, that investing in multifamily syndications is a powerful wealth builder. It really is. It's maybe not as hot as it was 3, 4, 5 years ago, but you put it all together, and it really is an attractive investment vehicle for various different reasons like cash flow, appreciation, and tax benefits. I want to bring up our passive income calculator. Okay, you can actually just scan this QR code, and you can download it. There's no opt-in, because you guys are already on our list. You can just download this thing right now. And before I bring it up here, just whip out your phone, and I'll put this QR code up in a second here as well. Let me give you a quick tour, and I'll put up the calculator here. So this is the passive investment calculator. And so what this does is it allows you to modify everything. Blue in our calculators is editable. Everything else is black is a formula, so be careful when you edit this thing. You can basically create a copy of this and mess around with it yourself. But so, for example, if I'm investing $100,000 per year, every single year, and I get a 5% cash-on-cash return, and I get a 10% profit at sale. So basically, what this is doing is it's a 15%, roughly a 15% IRR by the time you're done with it. So you're putting in your $100,000. You invested $100,000 new dollars. You get your cumulatives invested here. You don't have any return capital yet. Oh, you have a 5-year hold. I forgot to mention that. So you invest $100,000. Now let's look at the cash flow. You're getting a $5,000 return on the $100,000 on average. Okay, on average, there's a cash and cash return. No sale. So now my net worth went up to $105,000. Increased it by not very interesting. But if I move this forward, let's say I'm going to I'm going to start selling stuff in year 5, right? So let's say we're in this column here in year 5. So my net worth now is $452. I've invested $500,000, and I'm reinvesting the equity in here as well. There's not a mistake here. Okay, I just can't for some reason right now on the fly figure out why it says 455 and a net worth. It should be a little higher than that. But I've invested 552 cumulative in reinvesting the dividends before that as well. And you can see here the cash flow starting to build. And then here I'm selling in the fifth year. I'm selling that first one I bought in year one. So I'm getting $100,000 of capital back. And now my net worth is starting, and I'm going to reinvest that. My net worth keeps growing as well. Okay, and so now we go in here. You can see here that as you're investing, the cash flow starts to increase. So if I've invested, in this case, I've invested $600,000, and now my passive income is $100,000. So you can use this. You can use this calculator based on your own investment criteria, what your projected returns are, how much cash flow you can expect to have, and also by the point is what your net worth is going to be, right? So if you invested about $600,000 here so far, and your net worth now is $1 million, and you can see this kind of growing progressively as well. So a lot of high net worth investors are able to invest their money in real estate and start building up $200,000, $300,000 in passive income. And the advantage is yes, there is cash flow. Yes, there is wealth appreciation. But the other benefit here that we haven't really talked about is the tax benefits of this, which are now enormous. I mean, the only thing that's probably better in a tax category is oil and gas, where you can offset the passive losses in year one against actively earned income. Now, that's pretty amazing. With real estate, you can't do that. You can only offset your passive losses against passive income. But even that is amazing, right? With bonus depreciation now coming back 100% of it, you can literally write off 100% of your investment in year one, so you have these passive carry forward losses. Now, you got to pay the piper at one point when you sell at the end, unless you use other tax advantages. Like, for example, if you dispose of an investment in the same tax year, you would reinvest that, right? So you have a taxable gain in that year, but then you have another bonus depreciation, so they offset each other. Or you can do a 1031 exchange. We do that going into a deal and coming out of a deal, so you can do a 1031 exchange. And so you can actually reset everything and kick the tax can perpetually down the road, which is amazing. You can't do that with a stock market or anything else as well. So download that passive income calculator. Again, there's no opt-in, and just play around with it, and hopefully you get some value from that. And if you want to connect with us, you can have a call with us at nighthawkequity.com/call. There will be a little calendar widget, and then you can just book a call and just reconnect. We'd love to have a conversation with you. If you're new to investing, we'd have the conversation with you about learning a little bit more about what you're looking for, and then maybe we can tell you about some upcoming opportunities we might have here as well.